All right, well, we got a really good jobs number early this morning. It led to a pretty significant gap to the upside today in the S&P 500. Unfortunately, we were not able to sustain that gap. We actually ended up filling in most of it. We haven't filled in all of it. We filled in most of that gap this morning. Looking like things weren't necessarily looking too great in the middle of the day today. But then we rallied. We had a nice late day rally. Volatility dropped. The market closed near the highs of the day. A nice little push. So the question is, was that enough? Was that enough to really kind of bounce up and get us going into next week? Or what are we more likely next week to? I mean, there are some patterns that would suggest there is a pretty clear direction of where the options market thinks the market is going in the near future. I'm going to show you those patterns and talk about that. There's also a pretty, there's some technical signs that are suggesting that this intermediate run that we've been on pretty much since the August lows, but especially since those early September lows when we had that bull tag, it appears that that run is fatigued in a big way, and it's starting to show signs of fatigue. And then I'll break those down, and we'll talk about a really important week next week, why it's so important, especially from a technical standpoint. And what the ramifications are, how much of a move we may get. Like, we can actually kind of determine how much of a move we may get in the next week or two. I'll show you why based off the patterns there. And we'll talk about, again, which direction that move may be. And then we'll take a look at a stock that's had a nice little bullish breakout pattern itself. A little bit better than what we're seeing on the S&P 500, but it had a nice little breakout pattern, similar to some of the other bullish trades we've done, especially in the tech area. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, October the 4th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter, for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where we take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Come down to the bottom here. Click on that like button for today's Market Outlook. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, there's our bounce that we've had here. We're up about 51 points today, closing at the high of the day. That really produced, again, we talked about yesterday the potential for this bullish bounce in the short term, and we got that. We got a nice, good overbought momentum line. And really, this came about when I did my class at noon, or 2 o'clock Eastern my time. When we do our classes at Market Scholars, we were not looking that good on this. So really, a late rally here, a big push. You'll see on the intraday chart in a minute. Brought our momentum line up, brought the near-term line up. Again, one day, this is day one of being above 40. Now the question is whether day two will get above 80. And we're just not, we're not there yet. We'll see if the momentum line getting above 80 is a very good sign that the near-term line. But as you saw here, it doesn't necessarily mean that it will, like it should have done there, and it didn't. And so we'll kind of see what ends up happening. We're crossing our fingers that we can get that near-term line into bullish territory and back into the upper reversal zone, because that's a positive. But again, we'll kind of see if we can get a new high out of this move or not. We've seen it try to and then fail before. Same thing. Your momentum line is higher than the near-term line, but it did not get into the reversal zone. Doesn't guarantee that the near-term line won't. But again, the near-term line's below the intermediate line. The intermediate line's falling. So we have light pink shading. We had that bull tag. We talked about the bull tag giving us a opportunity to bounce. We did close above the high of the bull tag day, so that's a good sign. It wasn't a very big bull tag day, so it wasn't very hard to do that. We do have some A positive day today thanks to the very end, but it wasn't looking positive for most of the day, which makes me a little skeptical that we might get like this kind of move, or it looks like we might bounce out of a sideways, break out of a sideways move, only to not. That's kind of what I was expecting before this last late little push, and we'll see if that ends up happening. There's your NASDAQ 100. Again, it got light pink shading the yellow line yesterday, but it bounced up today as well. Its short-term sentiment does not look great. I mean, it is above 60, but the momentum line did not get above 80. So now we'll see if on Monday the near-term line, if the near-term line also gets above 80, or if it gets above 80 without the momentum line getting up there, because you would expect the momentum line will probably drop back down here. So that's at least the the intermediate line is above the market sentiment line. That's a positive. That's actually the case as well for the weekly charts. When you look at their weekly versions, you can see dark green shading the green line. The intermediate line is below market sentiment. That's a little bit of a concern, but at least it's rising inside bullish territory. Your near-term line is rolling back down. There's a chance that it will continue to move back down, and if it crosses back below this intermediate line, then we're back to being a potential bull tag again. And remember, bull tags on weekly charts start corrections, not just pullbacks. So we've been converging for so long that we might get a pullback / correction kind of at the same time here, because there's not much of a gap here by the time we get the bull tag before we start into a more of a deeper decline. So that's something to keep an eye on next week. You can see the S&P 500's chart kind of looks similar. It almost got an intermediate confirmation signal. We ended up being above 20 on the momentum line. But again, with how strong the near-term line is, what I talked about in my class today was a likelihood that the near-term line stays or goes even lower into oversold territory, and the near-term line falls. Right, that's more typical. And again, the intermediate line is very high. It's at 89. It's almost at 90. The market sentiment's almost at 90. So a breakdown of the intermediate line just by a little bit would get below the market sentiment. And on the Russell 2000, the intermediate line is also below the market sentiment line. But in this case, they're both between the reversal zones. So a little bit weaker pattern. Its near-term line did cross below the intermediate line. So the weekly patterns on the market forecast are suggesting the likelihood that we get a soft week next week. And then we'll kind of see how soft it is and what it turns into. Because the other weekly chart that we like to look at here is this the weekly crossover chart here. And you can see we ultimately closed 57.29.11, 57.29.18. We closed 0.07 of a cent higher, but still pretty equal. It's been lower for most of the week. It is set up for us to have a transition candle next week, especially if it's a soft week. If it's a soft week and that soft week turns into a transition / kind of bearish candle like this, where we get an upper and a lower shadow, but it's a bearish body. The body itself is already below its moving average. So if it keeps going lower below zero, then that's a bearish transition. And how bearish the candle actually is when it transitions remains to be seen. The Russell 2000 did form a transition candle this week. You can see that it also crossed below. Didn't get below zero, but crossed below its average. Did have a upper and a lower shadow. Was not that bearish of a week. So we're not too concerned. And we did not get the red arrow on the 10-week moving average. But you can see it is a transition, right? Nonetheless, it is a transition. We've had 2 weeks in a row now of not getting higher highs on the Russell 2000. And that's setting us up for, again, I mean, at least it's doing is it's saying that we're not as strong as maybe we think we are. Obviously, we don't have 3 green arrows anymore on any of these charts. The 2 red arrows on everything. We just don't have the moving average red arrow on the large cap indexes. We had 3 red arrows on the Russell yesterday. We only got 1 of them back. The other 2 are still red. So you can see the 2-line version of the chart. We are still above the 17-day. We were below the 8, but we did not get below 17. We bounced back up above the 8, but the MACD is still below its moving average. The histogram is negative. So we're still in this convergence mode, right, where you're above the 17, but where MACD is still below its average. that's not bearish, but it also limits the bullishness, and usually that is and you can see this was below the 17 and the 30 barely. It popped back above the 8, but still obviously in clear convergence mode, and it's stochastics is almost in bearish territory. So it's not all roses today. We had a nice little move higher at the end of the day, but it didn't necessarily solve what we needed it to solve. The DMI still is pretty neutral, considering that both are well below 25. We had that unique day yesterday where they were both below 20, but they're both below 20, both below 25. That's not the most bullish pattern either on the DMI. The RSI and the CCI had been, wrong chart. They had been bullish. Here we go, RSI and the CCI. The RSI popped back up above 60. The CCI is not back up. Still hasn't gotten above. On both these bullish moves, neither one of them did we get above 150 on the CCI. You like to see that kind of when you're coming off of an intermediate low point at least to kind of start the move higher, because something like this, right? Get up there to start the intermediate trend. It doesn't have to stay up there the whole time, but just kind of get us going. Here, it didn't at the start. Then we went sideways for so long. Then we finally broke out and we got our move going here. So we haven't seen that yet. We've been bullish. We haven't been very bullish. And then if you look at like the Ichimoku cloud, we are still at intermediate strength trend. We have not broken it into mature stages yet, where we can really solidify the move like we saw in both of these other instances. We haven't had that yet, and we're susceptible, right, to it not actually getting there the longer it goes without it. And you can see we lost the trend yesterday. The trend quality both went to 0 yesterday, but they bounced back up both, but neither one of them are even at weak strength. Even though we're above the cloud, the rate of change is slightly positive, but we're kind of slightly above the green line and this above the blue line, but there's just no trend going on at all. If you look at the Bollinger Bands, the S&P 500 is not back up in the upper quartile of its bandwidth. Its bandwidth is falling. It's almost back into the Keltner channels. We haven't been above the Keltner channel this entire run. Again, that's something you like to see towards the beginning of a run to keep it going, right? Just like both these instances, you like to see that run to keep the intermediate run going. We haven't seen that in either one of these instances yet. And now we're losing momentum instead of gaining, which makes it even less likely we'll get up above that level. Now, if you take a look at the intraday range, excuse me, we did close near the high of the day. I talked about that in my class. If we can close near the high of the day, we feel better about things, and we ultimately did close pretty much right on. Well, we got a new high by the end of the day today. So closing at the high of the day is the best possible thing. Higher high, higher close. Closing above yesterday's high. Did not yet get above last week's high and get a new high point, though we are closer, so that's a good sign. But because we didn't get one, now we're below 70 on this. And if you look at this range, so here's where the low is today. Monday, the low is still going to be there. Tuesday, the low is still going to be there. On Wednesday, the low is going to ramp up big time. So you see all the way to the right where my low is going to be on Wednesday. On Thursday, the low is going to be here. And then on Friday, the low is going to be right there. So if we don't get a new high, and especially if we don't get that big of a new high, from basically that 539 down at the bottom all the way up to this 560 where my cursor is, if we don't get a 20-point move to the upside in the next week or two, then we are going to be very susceptible, right, to a break. Because that's, if we don't get a new high next week and we move lower, which is kind of what I'm expecting will happen, then we break through 560 and we're bearish, right? Now we have a bearish room pattern. We have a bearish trend. So really important. And I say 20 points because if you look at the range here, you can see the range is it's falling, right? It's been below average. The volume was below average. It's been falling, but it's also been falling not just on the daily chart, but also on the monthly chart, specifically the options expiration month. As you can see, the options expiration, the range right now is about 20, or going into this month, the range was 29, almost 30 points. The range right now is 9. So we could have, in last month's range was 33, which is, a little bit above the average. So we're just to be a normal month, we still have a 20-point move left. And that's kind of goes to show what I just showed you on this chart. If we get a 20-point move to the upside, and again, in the next 2 weeks, because that's all we have left on this expiration cycle. In the next 2 weeks, if we get a 20-point move to the upside, then we're fine. This moves up 20 points by the end of next week. This moves up 20 points. Maybe not by the end of next week, but within the next 2 weeks. Everything would be fine. And we don't have to worry about new lows. We'd obviously have easily new highs, so we'd be fine. But if we don't, and we break below this expiration cycle's low, which is right here, this 570, 565 level, then we're looking at 20 points to the downside. That would put us at 545. And that would be easily, within, again, the next week or two, that would easily put us at new lows. And you can see, again, that's the path of least resistance. I mean, there is not a lot of resistance to the upside. We just have to break through these highs here. But that's not, those aren't strong resistance levels. But there's not a lot of support holding us up. We're very top heavy in the 4-week range. There's not a lot of support here. So we really need to break out early next week. And like, if we can get a good day on Monday and get that good bullish near-term peak, great. If we don't, and we end up, which is what I expect, if we end up down here like 567-ish by the end of the day Monday, or at least pointing in that direction, then it will make us very susceptible to getting that 20-point move in the wrong direction. Again, just to get to a normal month, much less an abnormal month, which is outside of that range. So that's the kind of setup we're having. Again, I showed you the skew, or I'll show you the skew here later. The skew is high, right? I think the market is actually leaning. The options market is leaning towards that 20-point move being to the downside. The VVIX did drop, but it didn't drop back below 110. So we are still susceptible. Like, we're still closer to 20 than not. We're not back below 90%, which I thought we would be. We're not back below 110, which I thought we would easily be. So with the skew being high, I mean, it's a rare combination for the skew to be above 160. It's not very common for the VVIX to be above 110, right? So you see the VVIX. It's not common for the VVIX to be above 110, but it still is. And it is there, and the skew is there. Again, the way for skew is to drop isn't for the market to rally, because the skew typically just stays high or goes up higher when the market rallies. So if we get a 20-point move to the upside, then we're looking at the skew being above 160 for a long period of time. No, if we get a 20-point move to the downside, that's what makes the skew drop, and the VVIX would be susceptible to that, considering it's still above 110. It's a very rare combination, and it's a combination of fear in the markets right now, which is not the kind of combination you would have going into a weekend, coming out of this jobs report, going into an expected weak inflation report, where you'd think, oh, the market should be pretty bullish. I thought it would be pretty bullish. We talked about last night's video. Obviously not necessarily the case. All right, well, let's go ahead and take a look at what's driving the price action here. As you can see, very good day today for small cap stocks, QQQ, everything was rallying up. In fact, a nice little close after gapping up here, the highest. We almost got back up to the highs of the day, both on the Russell and on the Qs. Emerging markets continuing. It gave back some of those gains from last week, early this week. In fact, if I were to zoom out to now take a look at the rest of the week, you can see that it did give back some of those gains early. Here, a couple down days, Monday and Tuesday, but then Wednesday popping back up, down on Thursday, and then back up today. So finishing near its highs of the week after a very strong week last week, of course, with the China news. Bonds finishing at their lowest level of the week, way underperforming every other asset class. Kind of goes to show just how strong the move on bond yields has been. You can see, look at that breakout move up to 3.98%. That's having an impact. If you take a look at like the mortgage rates, they were updated for today. Sorry, not this one. It'd be this website, this tab. If you take a look at the 30-year mortgage rates, jumping up from 6.25% yesterday to 6.5% today, so almost 30 basis points, about 27 basis points jump higher. So probably not the intended response from the real estate market. So might impact ultimately what's going on with real estate. In fact, we'll take a look at that here in this. Well, you can see it here, real estate, really kind of underperforming everything else, right? Outpacing bonds, but underperforming everything else, including gold. And remember, commodity, even the dollar took off again today, like, really strong. So the 10-year yield breaking out. If you take a look at what the dollar's doing, it's also breaking out. You remember, they're also breaking up above. We talked about this in yesterday's market outlook. They're also breaking above their 8-week moving averages for the first time. And now they're even getting that much closer to being above their 17-week moving average as well, right? They're sitting right on it, and the MACD is actually crossing over. In fact, we did cross above it on the 10-year yield. So, but keep in mind the 10-year yield will be limited. It probably won't. If it does go up past, if this 4.2% is probably about where the Fed will end up cutting rates to, right? So, like right now, I mean, the odds for rate cuts are coming down. Not for the next meeting. The next meeting, the odds are still 100%. But the odds for a 50 basis point cut dropped to practically nothing today. So pretty much wiped out that employment report and the wage report component of that jobs report. Pretty much wiping out the odds for a 50 basis point cut at the next meeting. In fact, there is now a 4.5% chance that we don't get a cut at all. Right, so I mean that's been zero for quite a while. If you look at this 4.7, I mean all the way to July, we've had over 2 months we've had 100% odds that we won't get a cut here, and now it's at we're at right and here. So it'd be at the November meeting. Right now we're at 4755. So that is this green line. So it's really since that 19th that we've had 100% odds of another cut there. And that's bumped back up. Again, the now 1.1%. But you can see it's non-zero. But this did get wiped out. We had a 1 in 3 chance. We had a higher chance a week ago of a 50 basis point cut. It's gone now. So we're not going to get a 50 basis point cut in November. The odds of another cut in December, but you see that now we're looking at getting into this 4% range, and if I go to January, you can see the odds of being here again as another 100%, pretty much 100% odds that would be actually about 86% odds that we'd be down to 4 and 4.25. That's where the 200-day moving average is. So I mean we're looking like that's probably where the Fed may end up stopping their cutting cycle if yields continue to move higher like they've been doing. And I expect that they will. I mean, this is a good breakout pattern. I expect that we'll continue to move higher, not at the same pace, right? We're not going to get this, another big range like this. We have the CPI report, which will come in pretty light. It's expected to be pretty light, the next CPI report. So that's not going to be a shocker to anybody. That's actually on this tab here. You can see it's expected to be light. But the problem is, so that's this September one. It's due next week. The next one, though, is expected to jump back up to pretty decent levels. This one will be released after the election, the week after the election. And you can see that will be our first month of it going, the CPI, the headline going back up. After dropping down to almost 2%, dropping down to 2.25%, it's expected to jump back up. Just to kind of give you an idea, some context on that move. Here is the CPI report, and you look at, again, you saw what it's expected to do there. Like right now, the year-over-year rate is close to 2%, 2.6. The lowest that we got was, let's see here. This is the lowest we got, 2.59%. It's expected to go down to 2.25% next week, right? So even further, but jumping back up to this level after the election. Because you can see, the 0.31% jump involved. That's the base effect. The last October number was a really, really low number, and so if we outperform that, which we're expected to do, that will bring the year-over-year number up. You can see here that would be to kind of give you an idea of where 0.31 is on the chart. If we get a month-over-month figure, that's where 0.31 is. It's a pretty good result. Like that's a pretty strong result there. It's not too weak, but it's also not, it's not weak enough for the rates to stay down at 2%, right? It's expected to go up, and assuming Commodities continue to rise, which they've been doing. You can see commodities are showing a similar pattern, breaking up above all these moving averages. Big breakout move here, as you can see on this weekly chart. It's only up 0.25% today, but it's a very strong week for commodity prices in particular. For crude oil, also had a very strong week, almost back above its 17-week moving average, getting back up to 74. So this is expected to move up again towards 80 and higher. Again, the more that moves up, the more this will be potentially up to 0.31%, not just here in the November release after the election, but also in that December release, the November result for that December release. And you can see you get a couple strong, this one will be weak, but if you get this number in November and another one like it in December, then you can pretty much write off any rate cuts in the early part of 2025. The Fed will, obviously the 30-year mortgage, you've already seen what it's doing. They're not going to want inflation to continue to move higher. And you've got two low base effects, so the year-over-year rate will push higher in both those months. So you're probably going to see most, if not January, probably March going forward, you're going to see all the odds for cuts coming out of the system. And that will most likely put some pressure and create some volatility in the markets. As you can see, right now, somebody's preparing for something like that. Because if you look at like what volatility has been doing, the skew has been up to very, very strong levels. If you look at the skew here, it's up to over 160. Today's skew, when it gets updated, will be 162.78. So we have that's a very high level. The 20-day average for the skew is at a very high level. The market is worried about something, right? It's obviously not this next CPI report expected to be tame, but you got earnings results coming up, the election coming up, that November jobs number. Considering today's jobs number, a lot of it. I've read that a lot of today's jobs number has to do with a big increase, like one of the biggest increases in government job workers that we've seen in some time. And so, what kind of revision might we get? Because if you notice, if I were to take a look, because we also had JOLTS, the JOLTS come out this week, the job openings, hires and quits. So when you look at that data point, it's on the Fred database. All right, so if you look at that data point here, pull this up, and a little bit of a jump in the total non-farm job openings. You can see we're still showing year-over-year declines, so not as big of a jump as last year's would be August result. This would be the August. In October we're getting the August result, so it's a little bit further behind, lagging behind. But what really is the concern here isn't so much the job openings. Sorry, it is not just the job openings. It is also the hires. So total non-farm, we'll add that series on a year-over-year basis. It got more negative in August than in July. And then also the quits. All right, so the quits here, we'll throw that on there. Oh, dang it. I don't want that kind of a line. I keep hitting the wrong button. So add that. So there's the quits. Again, you can see also falling down to a bigger negative level. And then finally, the last one. Those two are leading hires and quits. And job openings are coincident. And then, of course, layoffs would be our lagging series within this particular series. And again, if I were to go back to the one-year chart, it's down. Layoffs are down too, so that's a relatively good sign. But this here doesn't really jive with increasing jobs numbers. Quits and hires are leading. Remember, this is August, so this is going into the September month that we saw. So this wouldn't suggest that September should be showing that big of a jump. Openings are down, hires and quits are both down, and they're all falling. Again, when you look at just their regular chart themselves, you might not be able to see that here, but they're all falling relative to where they had been, right? They're all below pre-COVID, like the hires is below pre-COVID peaks. The If I were to take a look at quits are also, you can see quits was at 2.1. It's at 1.9 right now. It's also below its pre-COVID peaks. And job openings are falling back getting down to the pre-COVID peaks that job openings has. So, there is a deterioration there that would suggest that there most likely will be some kind of downward revision to this jobs number, eventually in the future. But as of right now, it's done a very good job at making yields in the dollar and everything else go up, and that's having a temporary positive impact. But remember, this three-headed monster of commodities, the dollar, and bond yields all being higher has not been bullish for equities in this inflationary environment. So we'll see how that impacts us going into next week. We finished very strong here this week, but you would expect it would impact. In fact, we finished pretty strong enough that our McClellan oscillator, our breadth, started to improve by the end of the day. We only ended up with a minus 19. We were like at minus 40 here at the lows of the day. So we're still negative, which you'd expect when we're above 1,000. You turn negative on the oscillator, so we're still negative. If you look at some of the other breadth indicators that we looked at, they're all down. They're not negative, but they're all down. The new highs and new lows. This was updated last night. It dropped below 100, well below its average. This is updated here. The number of stocks above the 50-day moving average, flirting with its average, and its average is a pretty decently high level at 380. Number of stocks above the 200-day moving average, also flirting with its average, which is also at a high level at 380, which is making the ratio chart here staying right about that one level. If it gets above its average, that generally assumes a breakdown in breadth. Our new lows stay pretty low, so we're not concerned. We didn't get any Hindenburg omens after that 5-day streak we had here early in the month. We didn't get any more in this 30-day period, so that's a good sign. But the new highs, are back down, right down to 20. It says 206 there. The reality is once it gets updated, it'll be 165. So that's a pretty low level and a breakdown there. So again, a sign that a sign that an intermediate trend is mature is, they're going to be 185, so it'll be like right in this area. A sign that a intermediate trend is mature and closer to ending than beginning is a breakdown in all this breadth, right? These breadth indicators, and that's, kind of what we're starting to see now. The Qs, the ratio here is breaking back up, but you see not breaking out, right? So we've avoided kind of a breakdown in the Qs relative to IWM, which is bearish, below that 200-day moving average. We've avoided that for now, but we haven't broken out to the upside to really say, hey, we're pretty bullish here. Our Mag 7 stocks are going to lead us higher. And again, I think that's kind of why, you can see XLK, a good day today. XLK kind of back up. Here, let me pull up this chart here. XLE is still outperforming the market, which is not what we want to see. But XLK is back above its 8-day. It's back above its 50-day average. You still have this, you still have a positive rotation into XLK and XLC. XLY is down. But you see how the safety trades and energy are moving up now and gaining. And these two are still moving to the right, but losing momentum. It looks like we're rotating back into safety. And that would be my expectation. You can see if I were to take a look at the sector comparison and how they performed here this week. Let's go to the week that we've had. Energy obviously had the best week, again, because of what's going on in China. They're going to have a really good week here. So energy's had a good week, but you also see utilities had a really strong week as well. Financials, industrials, kind of the cyclical areas outside of tech. XLC and XLK doing okay, kind of matching or slightly outperforming. But your consumer stocks both underperformed this week. Real estate also underperforming. Again, higher mortgage rates, so real estate also underperforming. You can see materials, which is again a reflection of weak dollar, right? Like materials, the energy was able to overcome the strong dollar move, but not materials. And materials is again another reflection of the demand for a growing, a strengthening economy, and so that's not necessarily growing. And that's 70% of the economy is these consumers consumers, and these consumer areas both really underperform. So again, it just kind of goes to show maybe not as bullish as we like to think we are, and maybe more, going back to when we came off of this low, like we had that low point on September 6th. From that low point, technology, discretionary, communication services, all are big winners. So there is no broadening trade, right? There are three QQQ areas are still leading the market during the rallies, but because we've been broadening out over the past week or two, everybody thinks, hey, we're rotating into favor. No, it just means that we're mature and we're rotating essentially out of favor. And so we are setting ourselves up for a move in the other direction here next week after the move, especially the late rally we had at the end of the day today. All right, that takes us to our trade idea of the day. Let's go ahead and take a look at Datadog. You can see nice little breakout pattern here, closing up above all these highs, dark green shading in the green line, intermediate line crossing up above. You can see we've had 2 days now of the near-term line going from basically being below 40 to being up above 80. Boom, boom. Nice little rally up there. So good. In fact, that's the most bullish near-term line that we've had since way over here when we first started this bullish move. So a nice little move higher. You can see on the weekly chart, it's showing actually a potential golden cross pattern. We closed up above the 10 and the 40-week exponential. Higher Hakanashi close, obviously a much higher high. But you can see the PPO, so the 10 weeks almost about to cross, probably will cross above the 40-week next week, give us a golden cross pattern there. Obviously, you have 3 green arrows on the chart. Let's pull up the 3 green arrow chart here. For Datadog, 3 green arrows above average volume in the last so many days, so a good little move higher. Obviously, you have green shading and a green line here, so that's a good sign. Looking at the 2-line version of that chart, you can see we are crossing up above the 8 and 17 have already crossed above the 30, but now we're crossing above the 200 and potentially crossing up above the point of control. That's a very good sign for the S&P or for the stock. You can see on the weekly chart, we're also crossing above the 30-week moving average. And we're already above the point of control, already above the 200-week. So things look to be improving. Sentiment looks to be improving. You can see a lot of breakout patterns here on these other oscillators. Nice, beautiful breakout pattern on the DMI. Looking at the RSI, you can see a nice, beautiful pattern there as well. Let's look at the RSI here, like above 60, up above 200. Beautiful, right? That's a nice, beautiful pattern there. And then you look at like the Ichimoku cloud. We closed up above the cloud, closing up above the cloud, starting a new weak bullish trend. So that suggests that we might just be getting going on a bullish move here, that we're hardly like too extended right now. And then you see we're breaking up above the upper band and the upper Keltner channel with some positive momentum. The bands themselves are already outside the Keltner channel, so we didn't get a consolidation here. We just went straight from being bearish to being bullish. That's how kind of, we've had a lot of momentum on this move, but getting up above the band, getting up above the band, the point of control, getting that bandwidth moving higher, all very, very good signs. So I decided to be a little bullish on this trade. So I went down here and I sold the low 20 delta call option, bought the 135. So sold the 140, bought the 135. Position size for the normal positioning. About $500, getting about a 3-to-1 with a little wiggle room. This is a pretty speculative trade, but I like the technical setup on it for it to be bullish here without, sooner rather than later, right? Without necessarily having to wait and have that. I don't feel like I necessarily need more flexibility on the timing. Otherwise I would have sold the 135, but it got less of a return. But I would have sold the 135. I don't think we need that. I think I got plenty of flexibility for a pattern that looks like a nice bullish breakout pattern that we're getting right now. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all Monday.